Guest says housing is already in a recession, thanks in part to those high home prices, and it's going to take a long time to play out. Let's bring in Mark Zandi. He's chief economist at Moody's Analytics. Mark, great to have you with us. You know, the last time we spoke, Mark, I think a banking crisis happened. And so I'm wondering how you think that's going to impact the ability of buyers, for instance, to get that mortgage. I mean, Diana had mentioned a little bit of a respite when it comes to mortgage rates that has come, but we are going to be facing tighter lending standards.
Yeah, I don't think for residential mortgage loans, though. I don't think the banking crisis is going to affect the ability to get a Fannie Mae or Freddie Mac or a FHA loan. It might impact some of the jumbo part of the market on the margin, but usually those are bigger banks that make those loans, and they're in pretty good shape. So the fallout from the banking crisis will be significant. It's going to affect the availability of credit, but that's for commercial real estate loans, C&I loans, commercial industrial loans, consumer loans. Less so for residential mortgage loans.
But Mark, what about for the builders? I mean, I was just talking about how they're going to have to do more construction to meet this growing demand. They rely very much on the regional banking system. How is it going to be for them?
Yeah, good point. I was thinking about demand, but you're right. In terms of supply, in terms of the ability of, not so much, I don't think the publicly traded home builders, I think they have access to lots of different sources of capital. So I think they'll be able to get the capital they need. But for the smaller builders, and of course the home building market's very fragmented, lots of smaller builders, they do rely on construction and land development loans, and in many cases from small and mid-sized banks, and they are going to have a hard time getting those loans. So yeah, so the supply side of the market may be impaired, as these banks try to work this through, and may add to your statistic of homes that are sold but not yet started, because builders may not get the capital they need to actually start those homes.
How does tightening credit play out in your mind, Mark, when it comes to the impact on the economy and therefore, of course, housing ultimately?
Yeah, meaningful. I think this is a big deal. Small, mid-sized banks, these are banks, let's say, with less than $250 billion in assets. That's the bulk of the banking system. They account for half of all C&I loans, commercial industrial loans. They account for half of all consumer loans. Those are credit cards and unsecured personal lines. They account for 3/4 of all commercial real estate loans. In terms of the housing market, I think the part of the market that's going to be most affected is the multifamily market, in terms of multifamily developers getting the credit they need to put up the next new project. We need those rental units. We need those homes, but they're going to have a difficult time. So, my sense is, Melissa, this is going to shave meaningfully off of growth, and it's probably worth, if we're going to translate this into rate hikes by the Fed, at least a couple rate hikes, maybe 3. I don't think the Fed needs to do now because of the tightening in credit conditions as a result of the banking crisis, and that's to date. I hope the script has been written, but maybe not. So, given what's happened so far, I think the credit fallout will be quite material.
Maybe I misheard this, Mark, so I want to clarify. You say that what is going to happen in terms of tightening of credit is the equivalent of 3 rate hikes, 325 basis point rate hikes. That's a lot of tightening on top of what the additional hike they still might do, on top of the lagged effects of the hikes in the pipeline.
Got it. That's exactly right. Maybe I'd say 2-3 rate hikes, but yeah, I think that, and there's certainly a lot of uncertainty around that. We'll have to see how this plays out, but that's my sense of it. Yeah, so if they actually raise rates another quarter point, which is what was in the results yesterday from the FOMC meeting, on top of effectively 2-3 rate hikes because of the credit conditions. That's 100 basis points, a percentage point. That puts the effective federal funds rate target at close to 6. I think that's a pretty significant increase in interest rates, and I do think that puts the economy in jeopardy. If I were on that committee yesterday, I would have strongly argued, hey, let's just take stock here of what's happening to the banking system, what it means for the availability of credit and economic growth. We can always come back and pivot and focus on inflation. Goodness knows we need to do that, but the first priority's got to be the stability of the banking system. And of course, they did not do that, and I do think they're running a risk here.